Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of corporate reports so you don't have to. Today we are diving into Equus Total Return Inc.'s latest filing, and let me tell you, it's got a few interesting twists and turns. This filing is actually an amendment to a previous report, meaning they had to go back and fix something. And what was that fix? All about adding what they call inline XBRL tagging, which is basically a way to make financial data more machine readable. Not the most exciting detail, but it tells us they are working to comply with regulatory standards. Looking at the balance sheet for the 30th of September 2025, we see total assets standing at 31.4 million. That is up from 29.9 million at the end of 2024. This increase is mostly driven by their investments, which is what this company is all about, right? Now, what's really eye-catching is their balance sheet for equity. They have a significant amount in capital in excess of par value, which is essentially extra cash that shareholders put in beyond the stated par value of the stock. This has grown from 74.7 million at the start of 2025 to 76 million by September. However, they also have an accumulated deficit of nearly 50 million, meaning that over their history they have lost more money than they have made. This is common for investment companies, especially in their early stages or during tough economic times, but it's a crucial number to watch. Diving into the operations though, things get a bit more sobering. For the 3 months ending the 30th of September 2025, they reported a net decrease in net assets from operations of over $8 million. And for the 9 months of 2025, that total sits at over $4.2 million. That means the company, purely from its day-to-day business activities, is losing value. And when you look at the realized losses, it paints a clearer picture of the challenges. For the 9 months ending the 30th of September 2025, they reported realized losses on investments totaling over $7 million. This is a significant amount and shows they have had to sell off assets for less than they paid for them. Now, something that popped up this year is a warrant liability, a hefty $1.7 million. Warrants are essentially options to buy stock at a certain price. When a company issues warrants, especially in connection with debt, it can be a sign of trying to attract investors or secure financing under less than ideal terms. The fact that it is valued at fair value and is a liability means its market value is fluctuating, impacting their books. This operational struggle is reflected in their net asset value per S-share, which has dropped from 2.17 at the end of 2024 to 1.9 by the end of September 2025. This is a direct hit to what each share is theoretically worth. Let's pivot to their investments, the core of what Equus Total Return does. As of the 30th of September 2025, their total investments are valued at $28 million. A big chunk of this, almost 12.4 million, is in what they call limited liability company investments, which are essentially their stakes in other private companies. This category alone makes up 46.6% of their net assets. And where are these investments pointing? Heavily towards the energy sector. The energy segment represents a massive 86.2% of their net assets, with a fair value of almost $23 million. This clearly shows their strategy is heavily concentrated in this often volatile industry. A prime example of this energy focus is their investment in Morgan E&P Incorporated. This is a majority-owned subsidiary, and it represents a substantial portion of Equus's value on their books. They put in a significant amount of money into this company, and its performance directly impacts Equus. Scroll Morgan E&P Inc. Houston, Texas to scroll. Interestingly, Morgan E&P has had its own set of challenges. We see notes about its financial struggles and the potential need for external financing. This is a critical risk for Equus because if Morgan E&P falters, it could severely impact Equus's consolidated financial picture, even though they do not fully consolidate Morgan's financials. Their investments also include a substantial amount in secured and subordinated debt, totaling $10.5 million. This is a more traditional debt investment aiming for steady income. A key point to note is that many of these investments are classified as level 3 under fair value measurements. This means their value is based on unobservable inputs, requiring significant management judgment. This adds a layer of uncertainty to their valuations as it is not based on readily available market prices. When we look at the breakdown of these level 3 assets, we see that for their limited liability company investments, the valuation techniques relied heavily on things like proved reserve multiples and daily production multiples. These are industry-specific metrics that can fluctuate wildly with oil and gas prices and production success. Looking at the reconciliation of fair value for level 3 investments, we see that the 1st of January 2025 value for control investments was $27.5 million. By the 30th of September 2025, this had dropped to $22.8 million, a decrease of over $4.6 million, primarily due to changes in unrealized appreciation. which in this case was actually a depreciation. Now, let's talk about the bigger picture. The report touches on the US economy, predicting GDP growth for 2025, but also noting some headwinds like a slowdown in job creation and persistently high borrowing costs affecting the housing market. This economic backdrop is crucial because it directly impacts the sectors Equus invests in, especially energy. Inflation has been moderating but remains a concern, expected to accelerate in 2026. And interest rates, well, the Federal Reserve has been cutting them, but the future path is uncertain. This environment creates both challenges and opportunities for investment companies. The report also highlights activity in the private equity space. While there was a softening trend earlier in the year, private equity activity has increased sharply in the third quarter, contributing to a rise in mergers and acquisitions. Despite macroeconomic uncertainty, analysts project an increase in private equity activity for the remainder of 2025 and into 2026. Here is something that always grabs attention: a material weakness in their internal control over financial reporting. This means there were significant deficiencies that could lead to a misstatement in their financial reports. Specifically, they mention issues with applying complex accounting guidance for non-recurring events and transactions, and also with management's review of portfolio valuations. While they state no material misstatement occurred, it's a red flag that indicates areas needing serious improvement in their financial processes. On a more positive note, they state they have no material uncertain tax positions. This is good news, as it means they are not facing any significant potential tax liabilities from past practices. A major strategic point is their ongoing exploration of converting from an investment company, a business development company, or BDC as it is called, into an operating company. This is a significant shift. They are actively evaluating transformative transactions, which could mean acquiring or merging with a company that actually runs a business operation. The authorized shares have been increased to facilitate this. This shows a clear intent to move away from purely being an investment vehicle. Looking back at their recent actions, they sold Equus Energy in March 2025. While they received cash and preferred stock, the conditions for redemption of that preferred stock weren't met, leading to a significant realized loss of $2.7 million on that sale. This highlights the risks involved even in divestitures. Financially, they issued a convertible senior note in February 2025 for $2 million, with a 10% interest rate. This note is convertible into Equus's common stock. This is a way to raise capital, but it does add debt and potential dilution down the line if converted. Along with that note, they also issued stock purchase warrants. Initially classified as equity, they were later reclassified as a liability due to potential modifications, leading to unrealized depreciation. This shows the complex accounting involved with these financial instruments and the potential for value swings. As mentioned earlier, the sale of Equus Energy in March 2025 resulted in a significant realized loss. This means they not only sold it for less than they hoped, but the way the deal was structured led to a material financial setback. Finally, let's wrap this all up with the earnings per S-share. For the 9 months ended the 30th of September 2025, they reported a basic and diluted earnings per S-share loss of $0.31. This means for every share of the company, it lost value from its operations during that period. So, what is my take on Equus Total Return Inc.'s situation? They are clearly navigating a very challenging environment. Their heavy concentration in the energy sector, coupled with investments classified deep in level 3 unobservable inputs, makes them highly susceptible to market volatility. While they are actively pursuing a transformation from a BDC to an operating company and have increased their authorized shares for this purpose, the path forward is fraught with risk. The sale of Equus Energy resulting in a substantial loss and the ongoing financial struggles of their key investment, Morgan E&P Incorporated, are significant concerns. The material weakness in internal controls over financial reporting is another point that demands attention, indicating a need for robust improvements in their financial reporting processes. However, the company is making efforts to adapt, including internalizing management and reviewing strategic alternatives. The increase in their stock price trading at a premium to net asset value is a positive sign, suggesting some market optimism, but the underlying operational losses and investment risks cannot be ignored. In conclusion, Equus Total Return Inc. is in a period of significant transition and faces considerable financial and operational challenges. Their future hinges on the success of their transformation into an operating company and their ability to navigate volatile markets while strengthening their internal financial controls. It's a high-stakes game, and investors will want to see tangible improvements in operational performance and risk management. Alright, that is our breakdown of Equus Total Return Inc. Its latest filing, what is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.